Hi there, this is Kirby Scofield, Scofield Realty, and today we are going to discuss how much home can you afford and what type of loans there are out there to get them. And we're also going to go over rates, and because rates have been going up since the beginning of this year, we'll discuss what can that have an effect on you going forward if the rates continue to rise, and we have some samples for you with the average price home here in Las Vegas. Types of loans, you have VA. VA is anyone who has military service or family, and VA is your 100% loan. So the VA has a funding fee that would be built into your closing cost that you'll see on your stuff there. But as far as down payment, it's 100% of your limit. You get a certain, it's called a VA certificate. And so when you go buy a house with your VA loan and you're a veteran, you basically pay your closing costs, but you can get up to 100% covered. With that, say you buy one, you have 500,000 in a VA certificate, and you buy a house for 300,000. You still have 200,000 that you could spend on another home. Like later on, you want to do a different home, different condo, etc. But say you're moving, you get orders and you're moving base to base. You would take that 300,000. Once you sold that home, your certificate redoes the balance. So you go from having 200,000 off that five because you had a $300,000 house, you'd have your 500,000 back. And they can do that almost a day of close for you to be able to close on your next home. So VA is truly out there right now. The regular type of loans, your 100% financed ones. FHA is the next one. So this you'll hear a lot of times is called first time home buyer loan, but you don't have to be a first time home buyer to utilize an FHA loan. It's just consider that because it's a lower down payment and has easier credit standards to be able to get qualified. With that, you'd be putting about 3.5% down, 580 credit score or higher. They did lower where you could do a 510s credit score now. You just would be 10% down. With that, you'd have private mortgage insurance though. So on a FHA, because that you don't have 20% down, you'd have private mortgage insurance. We'll go over a couple examples later that I did on FHA so you can know the pricing here locally in Las Vegas, what the PMI costs. Other option is conventional. Conventional loans are between 3% to however much you want to put down, but normal is 20% so you don't have PMI. You'll still have private mortgage insurance, anything below 20%. But they have conventional loans, 3%. We on a video earlier we talked about our maxes now. It's around 666, 430 for conventional, 435 for FHA. So with that, you get over the FHA limit, 435,000. That's where you in the house 550. On an FHA, you'd only be maxed at that limit, say 435. So say we'll make math easier here. It's 435, but then it's 535 the house. That means you'd have to come up with 100 grand out of pocket if you were going to utilize or had to utilize FHA. With a conventional, you could finance the 535, and then it would depend on what you chose between the 3, 20%, etc. 3, 5, 10, 15% down, etc. And then from that would also determine based off your rates, if you're buying your rate up or down, if you got to do certain lender credits, etc. So all that comes from your lender. But the type of loans you have out there, VA, 100% financing, FHA, 3.5% down to 10% based off credit score, conventional, 3% all the way up to the max amount that you want to put down or that you can. If you're under 20%, you'll have private mortgage insurance. And then some loans of past and or specialty loans that go on products that cannot meet Fannie Mae guidelines as far as owner occupancy and or they have litigation, etc. on the building if it's like a condo, would be ARMs, adjustable rate mortgage. Those are what caused the crash in the past, so you don't see them. They're very far and in between and usually just investors using them. So ARMs are, you hear 3-1. What it means, your rate's a lot, you're paying interest only, but you're locked in 3 years, and then after that 3 years, it goes to a 1 year adjustable, and it keeps changing. And your interest only, but when that rate goes up, your payment goes up. And so that's what ARMs are. Hard money, that's another one, or private money. That's where if you have any difficult credit and or you're doing a certain type of investment, you do hard money. So hard money loans, typical, is 25 to 30% down and 1 to 2 points on top of the closing costs. So make math easy. Take a $200,000 house, 2 points would be $4,000 that you're paying on top of the regular closing cost. Closing costs for the conforming loans, FHA, conventional, VA, all those, you're looking around 2.5 to 3.5%. It's about 1% for your normal closing costs that you got to pay for title, escrow, HOA, what do you call it? Prorated things to the date that you close, and then between 1 to 2% for your lender base. And know that the lower the loan amount, it's actually the higher cost for that money in closing costs, and your lender would go over that with you. So when you're going to buy a house, so say it's FHA and you're doing 3.5% down. So 3.5% on 100,000, 3,500. But if you have closing costs 3.5, that means you're really 7%. So $100,000 house, you need $7,000 to cover your down payment, but also your closing costs. So our average price in Vegas, for example, is $435,000. 7% on that. That'd be $30,000 to cover your down payment, half of it, and then the other half, $15,000 or so, is covering your closing cost. So you have to have that saved up. If you're VA, you're just covering that closing cost. So know about 2.5, 3.5% on whatever your purchase price for that, because you're 100% loan to value. Rates, big thing everybody's talking about. So let's just go over some examples here. Currently, the rate, when I pulled it up on the app today, they're changing every day. So hypothetical rates in the future when you're watching this. Currently, for a $435,000 house in Las Vegas, if you bought it with an FHA loan, the rate would be 3.43% with good credit. Your total, so I'll go through all the numbers here. So your total monthly payment would be $2,757, $2,757. Principal and interest of that is $1,868 a month. Taxes $291 a month. This is in Vegas. It's different per market. Homeowners and mortgage insurance $426 a month, and then we put $55 a month for HOA dues, a basic HOA dues. So $2,757 would what it would cost you to get a $435,000 house here. 3.5% down is $15,225. So double that for what you need closing costs. About $30,500 to get a $435,000 house right now in Las Vegas. The mortgage insurance is $342 a month. So when I talked before about private mortgage insurance, on that loan amount on an FHA loan, it's $342 a month. If you put more than 20% down on conventional, you would not be paying that $342. So that's where, if you have the money down, you'd have to weigh out the type of loan with your lender, and if it's worth paying more down to avoid the private mortgage insurance and have more go towards principal and interest. That's a 30-year note. Now, say the rates keep going up. Everybody's freaking out like that's going to destroy them. Like, I'm not going to be able to afford a house, this and that. Here's what the rate goes up. I did a hypothetical, same exact numbers of everything except for the rate from 3.43 to 4.43. So 1%. A 1% full hike would take the payment to $2,998. So I'm calculating right now, minus $2,757, $241. So they aren't going to just jump a full point. It's going to go in increments. But if you sit and wait to buy, so this is where actually the time of essence comes in. If you think it'll be at least 1% or higher 6 to 9 months from now, you can expect for that same house that's $435,000, if it stayed at that price, to paying $241 more a month, almost close to 10% more for 1%. The other thing to think about when you're looking at that, if the rates are going up, and depending on your market where you're at, in Vegas we have not seen any price decreasing. We had 30% almost year over year increase from last year. So say conservatively 5 to 10%. Say we had that. Say just take 10% to make numbers easy. If you wait a year from now and it's $241 more for the payment, that house though is a totally different house. 435,000, 10% would be $480,000. So it wouldn't even qualify for FHA. You'd have to do conventional, or limits may go up. But now that house, you're paying 10% more, plus paying 10% more on payment. So it's one of those things, rates go up. Yes, it's not dramatic. But if you add up the total, it is a pretty hefty amount over a 30-year mortgage. If you wait, you're going to be looking 10% possibly if it goes up to 1%, which they say they're raising them, but we don't know what they're going to do with that. But just hypothetical, say we go to the 4.5s, 5.5s. So 4.5 would be $241 more. So 5.5 would probably, if we're just doing the math here, be putting around $500 more a month. So you can see the difference, what a rate. Now take that by 30 years. What's that house cost more? Plus how much the homes appreciate while you're waiting to get it. So my suggestion would be to contact, because if you're getting this message, you are in our client pool from one of our portals. We are Zillow and Facebook and Google and Realtor.com, our website, local advertisements, and you're working with one of our agents. And so what I would do is, if you've been on the fence, connect with your agent on our team that you're assigned to and tell them to connect you with a lender. We have a great lender partner, and they'll be able to run your stuff and help you decide what's the best loan for your situation, and run your estimates on these numbers like I did, but it'll be based off of your credit, your debt to income ratio, your possibility of down payment, if you want to do something with the rate. And that way at least you can see where you're sitting, and then hypothetically have them run it a year out if it went up 1% and the price of homes went up 10%. Kirby Scofield, Scofield Realty, we look forward to helping you this year. Thank you.